this workshop was published online by our media partners, Aviation Defense Universe. So I received a WhatsApp message from a colleague of mine, ex-army. Presently, he is in private sector in a leadership position in Hyderabad. So he gave me that message. I'll read out that message here. It's a small message. It says, "Good show, naughty. When is MOD getting faster and converting awards to work orders? It is work orders that startups, MSMEs need to survive. Only after survival comes growth through an assured order stream. That is where MOD needs to understand better. Best wishes for your workshop." I'm sure he is not alone. There are many of us here in this auditorium and also many watching the proceedings live on our St. Joe's YouTube channel who would agree with him. However, we have seen in the past 2 days during this course of workshop, the speakers, they have illustrated how the government has been, expediting and making the defense procurement faster. However, still there will be some gaps. So those gaps will be filled by defense venture capitals. So it is those venture capital that we are talking next. So I would request the eminent speakers of VC panel to come up on the dais, please, and take their place. Starting with Moderator Major General A.K. Chandan, PVSM SM, Lieutenant Commander Tony Thomas, Founder and CEO TTS Defense Services, Commander Navneet Kaushik, Founder Jaman Ventures, Tanay Walia, Associate 361 Asset, Suresh Kumar, Vice President, Idea Spring Capital. Please give a warm welcome to the panel. Now I hand over to the moderator.
Good evening to all the audience here. Thank you very much for bringing this panel together on a very important subject, which is actually the fuel for this entire system to run. I often tell in informal gatherings that economics is actually the basis of every single thing in this world. At the end of it, even marriage is an economic enterprise. So, if you do not have the right funding, we will probably move to a certain degree where some grants, etc., can take you to a point, and beyond that, then obviously the valley of death comes. So, after me, the ADG ADP will probably is already covered, but he's here and he can elaborate it much better. He is today serving and he is a practitioner for it. But all of these are actually encouraging building blocks of technology or coming up to the prototype stage. Once you get to start executing orders, that is where you need funding to come. And that is probably what we are going to talk about today. So I have, it's very interesting that there are so many organizations, so many institutions or, setups that have come up into this field. It's a sunrise sector. It is the next big thing, as everybody says. And this is where probably the funds are now getting channelized. So let me actually start by Mr. Sulesh. We will just take a couple of minutes, introduce ourselves and what organization we represent, what are the goals, but we'll try and make it quick.
Thank you so much, sir. First of all, just before I start this introduction, thank you so much for the opportunity, St. Joe's. Demystifying defense procurement, that's something which is, when I saw the title itself, I'm like, okay, I have to be here. I'm from Bangalore, took the flight and booked it, and this is very important for us. So I represent Spring Capital. We invest in early stage defense and deep tech startups, primarily in the seed and pre-series A stage. In that, we focus on 3 areas: AI, deep tech, and also life sciences, investment in life sciences startups as well. The thing we look at is a lot of the startups we focus on are very early in their journey, so things like R&D, research. We help them in that. We also have an in-house CTO, one of the few funds that have CTO as well. So tech IP and tech differentiation is very crucial for us. So yeah, that's a brief of Spring. Thank you.
Yeah. Hello everyone, I'm Danav Walia from 361 Asset. So for those who don't know 361 Asset, we are one of India's largest domestic private equity and venture capital fund houses. And about 6 to 7 months back, we have actually launched India's largest multi-stage defense and space fund, all raised from domestic capital. Till now, we have raised about 1,500 crores, which we will be deploying to at least 15 to 20 companies in the next year or maybe 2 years, right? So we are multi-stage. That means we back companies right from, say, the prototype stage to when you're well established.
So let me start by thanking St. Joe's for inviting us here. I'm someone who's been on the other side, and I've been lucky that my entire career has been with the Navy, where I was part of DGQA, I was part of defense acquisition, I was part of the projects, and then I was lucky to have got through Technology Development Board, which is DST's autonomous body. So that is where the function of financing came into play. So thanks to the Navy that I can understand whatever has been told here, and I have been on the receiving end of it from the other side as well. So I can understand both ends. So after that, we started a fund called Jamvan Ventures. We are focused only in defense. We have done our first fund from where we invested in 6 defense companies, and thankfully our IRR is in 3 figures. And we are now with a second fund, a 500 crore fund, again focused only on defense and dual use technologies. So I think we are the only fund in India which is saying that we are only doing this and nothing else.
Good evening to you all. I am Lakmada Tony. I was a DGNA officer for around 10 years. Around 12 years now I am into defense sector. We are invested in UAE via Aero Autometal Products Limited in the defense sector. We are supporting Edge group of companies, and in the US via Aethos Automotive Boston for the Ford and Humvee for the UAE market, and we have an industry we are supporting in Coimbatore called Aethos Automotive, which are the manufacturing arm. And now we are into TTL Defense Services as a third-party inspection service provider, creating a testing infrastructure in the Coimbatore Defense Corridor. Thank you.
Thank you very much for that introduction. So we have now a number of people, and let me actually start by putting the first question myself. I am not an expert as far as venture capital funding is concerned or defense funding is concerned. It is something that I have learned in bits and pieces on the job. But I must make a comment that whenever we have these kind of seminars, one of the sessions invariably is from that gentleman, I forget his name, who comes from Sydney. He comes in a number of times, he talks about what he can do. And his presentation is most interesting. It almost seems that he's carrying a huge bag of, money lying right out there. But the moment he finishes, the question and answers are so pointed and so, there is so much of aggressiveness कि आप ये सब बोलते हो लेकिन करते कुछ नहीं है and stuff like that. So I just wanted to, which obviously that's a government organization, so there's a lot of, angst at the end of that presentation invariably. But what I wanted to ask any one of you who would care to answer is, what are the actual challenges? Because defense firstly has 3-4 issues. One, it is, a monopoly, there is only one buyer. Secondly, the competition, whatever competition exists, there is, it has to follow a process, and the process, somebody can fall at any stage. And thirdly, every defense tender by itself, things have improved in a very big way from, in the last 10-15 years. But even today, there is a risk of every tender, or a procurement stopping at some stage because of so many compliance issues, etc. So what are the risks that you would visualize? And since you are handling money, which obviously belongs to somebody and you're responsible for that money, how do you leverage those risks? So Suresh, maybe.
Sure. I understand what you're saying, right? Because a lot of this, the thing is, one thing different from us and other funds out there is that we understand deep tech, and sort of deep tech and defense tech is sort of correlated. Like there are very long gestation periods, and we understand that. But one interesting thing which we are seeing right now of late is that the defense side is very quick. The requirements are coming out very quick. Probably the startups are not able to match that, and that's where we feel a lot of innovation has to happen. One interesting thing coming out is that a lot of R&D is now coming from universities, places like IICs, the IITs and stuff. We actually have almost four startups now which are founded by professors from IIT. So that sort of academia moving towards solving real world problems, including defense problems, is happening a lot more. In fact, IIC also has defense through the FSID over there. So I think a lot of that problem in terms of understanding long-term gestation periods is now being taken over. But otherwise, I think the gestation period is one big problem.
And the risk?
Yeah, the risk. How do you mitigate that risk, right? I think one factor is that a lot of the LPs, a lot of this is also LP knowledge, right? If LPs understand that, look, for example, we invested in dual use case. We can't invest only in defense, and that's not an LP position. That's a position we have taken that. Because we don't want any of our customer to have one monopoly as a buyer, as probably the defense in this case. So a lot of things we use things like, let's go for a defense use case. So that's one way we mitigate risk, but I'm sure there are other ways to do it.
Would you like to say something?
Yeah, I mean, when we come across companies, right, I think till now we would have spoken to about 300 to 400 companies just in defense, right? There are some common factors that we have seen most of them struggle with. I think, yes, product development does take time. Companies struggle with working capital issues. But the way that we sort of try to fight that is we invest in companies that we consider something called IP houses, right? So these are companies which are making sovereign IP. They are manufacturing new products, developing new products, right? So when that happens, the number of projects that you can apply to increases. When that happens, you are also opening yourself to export markets, right? Once you have all of those factors coming in, a lot of your risks do get mitigated.
So typically what happens is we have a misconception called a defense tech only. There's nothing called only a defense tech. Like being in the services, we have seen we also need water. We also need electricity. Not everything is a missile. Even if you break down a missile, there are subcomponents. And we still are at a stage where even the subcomponents are being imported. And a lot of time, like there's a company which we have invested, connectors. Now those connectors as of now are being imported. And those companies which are actually making these connectors from abroad take a long time. You can't customize it. Now there are a lot of such options which are available. And then like this is what I say to my LPs, that why should Indian defense not have the cutting edge tech? Why should I only be looking at substitution? Why can't we make something which is working cutting edge in the world, and if Indian defense doesn't buy it, anybody in the world won't. So that's the kind of tech if we are looking for, Indian defense will definitely buy it. And like once you are building something like this, like there are cases where the companies have built something, it has gone abroad, they have sold abroad, and then it has come back.
So two questions, Tony, maybe we can start with you here. One is, the typical issue of debt versus equity dilution. And, companies, startups are generally, they feel that equity dilution is actually the most expensive form of raising capital. So how do you tackle that? And second thing that, it's a question that bothers me. Essentially a venture capitalist spreads its bets. So maybe you put put out to 10 different, companies or 10 different projects, hoping that one would succeed. When that happens, so actually you are building in not 10 but 11x of this thing, because the money is only going to come from 1 and 9. So in another way also, this tends to be a very expensive enterprise.
Thank you, sir. Thank you for the question. The answer is that startups, MSMEs, initially in the cycle, whether it is in the seed phase or the growth phase or in the scale-up phase, approach funding agencies like VCs or angel investors or PE funds or HNIs without understanding what is what and which is which. VCs are not managing CSR funds. VCs are responsible to the investors for the rate of interest to protect their investment. So in the initial seed phase, my experience for a startup to be successful is that they should not get into debt funding. They should go for equity funding, and in the later phase, once they are into the growth phase and going to scale up, they will have enough stomach or risk appetite to pay the interest, so that the debt funding will be both beneficial to the investor as well as for the company. So that's my opinion.
Okay. Yeah, and okay, I had something. It's just got, the link just got broken. So anyway, anyone, we'll just open out this to the house.
Yeah.
Yeah, Rati.
One by one.
Rati.
So, I just wanted to ask this. There are many startups and MSMEs. Those who have seen their seed days and now they have been there for about 4-5 years, getting orders, contracts, but drying up, not having the funds. I know of a startup very well that they have got matured products which can come in the defense. They can bid, they will win it also probably, because the product is good. But this startup has refused to bid because he said, I don't have funds, I can't bid. Where will I get the funds from? So this kind of a story, I know of 3-4 startups that I am looking into. I'm sure this must be across the board. I also earlier tried that we should have some fund to be able to give to this startup, because their products, having validated their product, so that the defense forces are not at loss because of they not having fund but having technology. I don't know how this gap can be filled, because I have made them contact many VCs, but VC looks after their interest. They want to have their pie of equity. Everybody is wanting 51% plus, which no CEO, what is solved, who the startup will give. So ultimately it falls apart. And of course, that very difficult at that stage, as you rightly brought up. How do we solve this as an organization? Because this ultimately is not allowing that industry to grow or that startup to grow. Ultimately, they end up becoming subservient to a bigger master.
Yeah.
Sir, the point is very valid. A lot of startups need funds and they will have the potential in the technology way. We do the risk assessment in 3 metrics. First metrics is technology readiness level. We have seen TRL. Second is financial readiness level. How much awareness does the promoters have in handling the funds, in managing the, like we rightly mentioned, Mr. Sir, you only rightly mentioned about the compliance. Because regulations and compliance, are the promoters really aware from the start? Have they put certifications in place? Have they done the due diligence in ensuring that ROA and IRR are coming up rightly? So what we generally do, we take 3-year balance sheet. We see whether what is the earning before interest, tax, it should be more than 20%. The basic metrics I am telling. Over and above, we will look into. Profit after tax should be about 10%. So we are not talking about the higher level. And the 3-year balance sheet should be positive, the bottom line. Then what we actually see is the promoter readiness level. What is the promoter's vision? will the promoter exit? It means we don't know what is his risk-taking ability. He may exit after 3-4 years, telling that this is not my cup of tea. So all these mean these three factors: TRL, FRL, and PRL is what really we look into as a VC to put our bet on that particular company. So many a times these three may not be matching. First of all, there should be an internal audit from the company in itself. They should do it by themselves as introspection, and they should approach the VCs or the angel investors or the PEs with the pitch deck. Then the VC will actually look into. So many a times it doesn't happen.
So how many startups are there? So have you ever seen a venture capital fund asking you more than 20%, 25%? So anybody who's coming to you with a 51% is likely to be an investor who has an industry or he wants to own this company. You will only go to a individual when you're not able to raise money from anywhere else. A venture capital typically is going to look at a very few things. One, who's the founder? If he has a revenue generating which is already happening, I think it makes a good bet. The problem which you're trying to solve, what is the market size for it? If these two matches, a lot of VCs will be interested and the path can be worked out in between. But anybody who's coming with a 51%, basically most of the founders will not want to take it because then you're an employee in your own company.
Thank you. When you are dealing with defense startups, this is like Charan mentioned, the most money. You have just one buyer. So as a VC, how do you value it, and what stage you come in? In an early stage startup, you may not have revenue, but you may have huge potential. And the guy would have come very close to perfecting a product which has a market in the defense space. So all the investments that you have already made, typically how have you valued it? What was the ticket size? Can you give a feel to the audience?
At the early stage times, so like all the defenses thing, my fund was very small when we started. But we made bets which more than 200 investors had passed. We invested in a company, I'm naming a company, Space Fields, which was into solid rocket motors and propellants. 200 investors, including the top tier VCs, had passed them. Nobody was interested, nobody understood what they're doing. Luckily for me and for them, we met and we said, okay, we'll invest. Last year, they have done a 42 crores, fundraise. They have 5 IDEX challenges and they're building something for the forces which are beyond this thing. So when you're looking at defense tech, yes, you got to have a longer cycle, but every tech which we are looking at defense, not everyone is building a missile, like I said. Not everyone is making a gun. There are a lot of subsystems which are coming into play. Go with that, and yes, if you are making some big, rockets or something, then you got to have that kind of a team. So then the team becomes important. Why you will be able to do what you are telling the investor to do. So that confidence building comes from the team and your clarity of the mission.
Yeah, Rajiv.
So valuation, if you could comment on. Valuation.
So valuation depends on what is the kind of risk which we are taking and what is the market size and how likely he is to achieve it. So it will be a combination of all this. The earlier you come, the lower the valuation, like the TRL levels were shown. So at which stage you are, like somebody like when we started, we'll give, some people give it 10, 20, but we go, when you're coming for defense at the market, we see bigger, then you can go up to 40 crores, depending on again, the market parameters on this, at what stage you are. And every, every milestone you meet, what you have predicted generally gets you the next stage.
What kind of exit you look at?
Please look at an exit, sir, at a stage where in 2-3 years, if we have a 5x, 10x, I think they're good at, but at some cases, typically investors will tell you if the going is good, why exit?
Yeah.
IPO stage.
2 questions. One,
Only one, please.
Okay.
One,
Sure. What is the typical check size, for that you do, and at what stage?
Yeah, so we invest in the seed and the pre-series A stages. Typical check sizes ranging from 10 to 20 crores. So in the round size, so 1 to 2 million, so round size of 3 to 5 million is what we look at. We invest, we're okay with pre-revenue. We invest most of our startups are in pre-revenue. We're not okay with pre-product, so it can't be an idea. So some sort of an MVP, some sort of prototype, we have our design partners. That's where we typically come in.
Yeah, sure.
Sir, I would like to.
Yeah, so I mean, just to give our perspective, right? So we invest anywhere from say 20 crores to 200 crores in a company, and since we are multi-stage, we will come in at all sort of stages. Earliest we try to start is where there is some sort of a technological milestone that is developed, maybe just at the edge of having a prototype, right till you being established and want to sort of raise funds maybe for another plant or something like that.
So we take it like biometrics. No two biometrics are same. So we cannot evaluate no two companies in the same way. So there are a lot of metrics to be understood to come to the valuation stage, wherein in the initial seed stage, mostly it will be ideation, idea creation or proof of concept stage. That time we cannot put in the bet. So what we do, we come in at the scale stage. After 3 years, the scalability is very important. By the 3-year time, the promoters also will have the vision and understanding about how the business is going up the cycle. Because generally we exit, our investors are interested to exit in a 3-year time. And the check size generally can go from 2-digit till a 4-figure. So because the type of VCs or angel investors or PEs are different. Everybody has got different risk appetite. Somebody has got a 4-figure capacity and somebody has got 2-figure capacity. So we do the matchmaking according to the company's ability and capability.
Sir, I would like to
I'll just
know.
answer this question on this. We have done from 1 crore to 7 crores, and now with the next fund, we are going 10 crores to 30 crores.
Sir, I would like to know your views on creation of a defense fund of fund, wherein the government as well as the VCs like you chip in and build a bigger bucket, and which is available for maybe the schemes which are being run by the government or maybe somebody who's having a very high potential of a success.
It's a very risky question. Why? Because investors doesn't want to get into a handshaking with government entity because business is entirely different. That's what I mentioned initially. You should not approach VCs like in a CSR way. Yes, CSR funds can be used to create an environment wherein defense ecosystem can be improved. That's my opinion.
So fund of funds can work, but that fund of funds, the money can be pooled together. The defense can put in some money, and or it can, like what RDIF is doing. Right, you give RDIF gives, let's say 50 rupees. 50 rupees I'm supposed to raise from the market. Total 100 rupees is available now, which I can deploy on the sectors which I have said in my TPM or which has been agreed upon. So if it's a defense fund of funds, a certain money will come from the defense that fund, but the freedom to deploy that fund will be with the VC, because VC's money, the investors, LPs who are there, we have to return it in a certain time frame. But yes, it's a good idea to have it with the similar to RDIF, so defense can have their own funds.
So the last question from Group Captain Narayan, please.
Just one point here. I think the fund of fund is a good idea as well. If you look at the BIRAC concept, like BIRAC is an entity which looks at biotechnology startups, and they have the expertise, they have the incubation support for that. So if there's an entity that has a particular area of expertise and they want to collaborate with the VCs, I think it's a great model, and they have almost now the 3rd fund right now for them in the fund of funds model.
Group Captain Narayan.
How do you
Okay, how do you deal with the R&D complex funds, like we were having a discussion on propulsion system, where there could be, theoretically it is close to the POC stage, but the timeline for certification and validation and induction are longer. Is there a thought process on those, because critical technologies we are looking at, which could be time consuming and cost intensive? Thank you.
So I'll answer this one. I mean, at least a lot of VCs or investors, right? We may not have sort of the same perspective as sticking to government regulated certifications. There may be a possibility of having some sort of a tech demonstration where you are able to match a certain benchmark. Now, what that benchmark is or what that point is, I think that's best decided by you, but it has to be something that is universally sort of accepted and something that can prove that there is an actual possibility here.
Sir, I just have one point, not a question. Take 30 seconds. And this point is actually from the industry. Last week I was there with SIDM.
This point is actually from the industry. Last week I was in an interaction with SIDM. And what came out was that, where people are looking for funds, while the first point is that yes, defense, long gestation period is one. High risk, yes, very true. But the cases where somebody has already got a purchase order or a supply order, contract, and then now he is wanting funds so that then he is able to honor that contract. There also, the VCs, they are not really very keen because they still think it's a very high risk. Whereas if you've seen this, after going through the whole process and two of them here being, saying ex, who dealt with the procurement and all were aware of it, once it's got the contract, that is very much 100% sure. So in those cases, they must be funded appropriately so that then they are able to honor the contract.
So in those cases, more than happy to fund them. Only thing is, like I said, VC is looking at only not on one contract. He's looking at what is the growth side. So if the market size of the problem which he's solving is big, I don't think any VC, if any VC is saying no, sir, we're more than happy to do it.
Thank you.
So thank you very much for a patient hearing. It was a fascinating discussion. I think we need more of such discussions, and I will request DG Sanjos, maybe we could have.
So just one thing, can anyone of you throw a light on, what is the a ladder of kind of investment? For example, you start with bootstrap, and then you have seed fund, and then you have, what are the series kind of, how do we go about it?
So, I mean, there is no sort of.
You can first rattle out what are the
So, I mean,
kind of funds.
Initially, when you start out, right, almost all founders end up being bootstrap, which is self-funding projects, right? Then possibly you raise a small amount of capital from, say, friends, families, or maybe certain industry professionals. Then you end up going to, say, a venture capital fund, at least when you.
So that is seed part?
Yeah. Then it becomes like a seed stage, and then as you sort of go, it becomes Series A and B, C, until you're pre-IPO. But there's no sort of fixed definition that everyone agrees upon. Something can be Series A for me, something can be seed for them.
So where does venture capitalist comes in?
So we can come in at after the bootstrap. Bootstrap is basically by definition somebody doing it from his own money or from friends and families. After that, pre-seed, seed, Series A, pre-Series A, B, VCs can come in and all of them.
And what is this pre-money and post-money?
So pre-money is before I put in the money. Let's say it's a.
So valuation it's a valuation,
link,
but how do you come out with it?
So valuation, okay, there is a way of doing it. There's a technical way of.
No, that I know.
But typically that
value of
doesn't
money.
work. It's between
cash
the,
flows and all.
Yes, sir. But it's between the two. It's the investor and the founder, whatever they agree on. Well, mostly that is what I see. Yes, I'll justify him to get it as low as possible. He'll justify it to get it as high as possible.
So post money is basically when you start
after
the revenue.
No, sir. Post money is after the investment. Let's say I am investing 10 crores, so his pre-money valuation is 90 crores. I have put 10 more crores, so now his post-money valuation is 100 crores.
Okay, thank you.
The last question.
Sir, I just have to answer, I think,
Just
Naran sir.
1 second. You go to him in the end.
Okay.
Monica, please.
So my first question is for VCs, especially Sulesh and Tanay. How do you go about the calculation of TAM? Since you don't, maybe you have expert, are the LPs from defense, or how do you go about it? Especially TAM and also the SOM. Are you looking for the export thing also? Do you go till that level? That is number one. Number two, there is a apprehension not only about the equity dilution, but also the push from VCs for ROI, which is contradictory to the innovation. That is also one of the apprehensions from the startups. So I would like you to address that also. And third thing is for you, sir. So, just last thing. Okay, fine, sir. Done.
Next.
Yeah, your first question was, okay, sorry, here, I got the TAM, yeah. Okay, so we invest in early stage, right? So TAM is completely what you show us. So after, to be really frank, it could be individualistic, right? I don't give much value to the TAM. A TAM is a mindful figure that, okay, how large the market is. I have a ballpark figure. If the market is like very small, for example, anything less than 500 million, probably won't excite me. But the TAM is completely what you show me. I will do my research post what you tell me about what TAM could be. But just keep in mind that that's just like a cutoff thing for us.
You can respond to book in RN.
Yeah, form is again, it could be expert. Yeah, whatever you do.
Just respond book in RN and to close discussion.
I'll just, so on that part, I'll agree and disagree both. TAM, yes, it's a figure which is shown, and after that I may not bother, but in my mind or any investor's mind, it should be how big he can go. That's where he's asking. Sir, as far as when should the startup take money who's in the early stage? Fund have life cycles. So if like I'm in the first year of my fund, it's a 10-year fund, the pressure on me for an exit will start after the 5th or 6th year. Now, if somebody has started a fund and you are in the 4th year or 5th year of deployment, the pressure on that exit for that guy would be higher. So if somebody has to take money, and if you see there's a long gestation that is happening, it's always better to go with the funds which are at the early stage. Having said that, if they are not coming, take money from wherever you're getting, and that is where the point comes in. The venture capital will push a bit, and it's a balance. You push too hard, it burns off, and if you don't push, it just keeps dragging.
So with that, we'll close.
So all it remains